Hi there, this is Aditya Aluwalia from Finstructor. We'll be starting off with a very important review for the CFA Level 1 exam called Corporate Finance. So Corporate Finance forms about an 8% weight on the Level 1 exam. This moves up to about 13 to 15% even on the Level 2 exam. So very important that students master the concepts taught at this review. We advise that you visit the section on time value of money before you proceed with this video if you haven't already watched it. So it's not that you won't be able to understand the concepts, but it's just that the understanding will be better if you've seen the time value of money section. So the first chapter in today's review deals with capital budgeting. So we'll start with the definition and the principles of capital budgeting. Understand the methods of analysis called NPV and IRR. What happens when there's a conflict between the two methods? How is the share price impacted by the NPV of a project? And finally, the two other analytical tools of payback period and profitability index. So how do we define capital budgeting? So capital budgeting essentially is a process of analyzing capital expenses. And what is a capital expense? It is an expense which is made today, or the outflow is today, but the inflow comes over a longer period in time. So capital budgeting is the process of identifying and evaluating projects where the cash inflows will be received over a period longer than a year. Now, the 4 steps in the process of capital budgeting. First is the idea for the expense. It's called idea creation. So let's expand into a new market, or let's replace an existing technology. Let's start a new product, etc. The ideas then need to be analyzed. So we're gonna spend significant amount of time in this second step today, that is analyzing project proposals to decide whether they add value or they destroy value, and how much value, if at all, do the projects add. Create a firm-wide capital budget. In most circumstances, companies do not have infinite amount of capital, so they need to prioritize which projects are adding more value as compared to the others, and which ones should be taken first and which ones should be left out or should be taken second, even though all may be adding value. And finally, when we are doing step 2, more often than not, we will be making a lot of assumptions to decide whether the project is adding value or not. Whether things actually pan out according to our assumptions or not is what we'll see when we monitor our decisions and conduct a post-audit to review our investments or to review the capital. So what are the general categories of projects that require this detailed analysis that we're going to study? So there could be replacement projects which are required to maintain the current business. So these projects are normally taken in the regular course of the business, and not much analysis is put in because it's for the current business to sustain. If the replacement project, however, is for cost reduction or for some other end, then more detailed analysis will be required to see whether it makes sense to replace our existing technology, etc., for cost reduction or not. Similarly, expansion projects would require a lot of analysis. Decision to enter into a new product or a new market would require analysis. Certain mandatory projects, now these are mandated by the government, like all companies that are mining need to plant trees. So again, it's not something that we can do away with, so we have to do these projects. But yeah, how can we do it in the best possible way that maximizes shareholder wealth is a part of the capital budgeting exercise. Other projects could be pet management projects. So the management or the CEO always liked the real estate business, so he's entering into it. Or it could be other projects like doing charitable activities, setting up a hospital, etc., social work, corporate social responsibility, which also may require the firm to see how much money it can spend on such activities. So it's a broad category of projects that will require the analysis that we will study henceforth. Very important, arguably the most important 2 slides of today's review, that is the key principles of capital budgeting. You must always remember this. First, and please commit them to memory, decisions are based on cash flows, not net profit or not accounting income. So net profit doesn't matter, guys. What is the cash inflow and the cash outflow that the project will deliver is what we are interested in. And when we are studying cash flows, we need to focus our energies on the incremental cash flows. So what has already come or what has already been spent does not matter. Incrementally, what will be the inflows and outflows is what I'm interested in. Sunk costs should not be considered. So if you've already given for some consultation fees, or let's say you've spent some money on advertising, see, whether you take that project up or you don't take that project up, that cash is not going to come back. So analyze the incremental cash inflows and the incremental cash outflows to decide whether the project should be taken or not. Sunk costs should not be considered. Externalities must be considered. So if the new project is going to eat up sales of an existing product, that is, it is going to cannibalize some other cash flows, then that impact should be accounted for. Similarly, if there is an external benefit, that is, launching this product will also help the sales of another product, then that external benefit or external cost should be accounted for. A conventional cash flow pattern is where we have a series of cash outflows or one single cash outflow, that is the initial investment that we make, followed by cash inflows. So t equal to 0 would be a cash outflow, and t equal to 1, 2, 3 onwards, there will be cash inflows. So this is a conventional cash flow pattern. In an unconventional cash flow pattern, there is more than one change in sign. So t equal to 0, I may have a negative cash flow. Then for 2 years, we have positive cash flows. And year 3 and year 4, again, we have negative cash flows. And then again, we have positive cash flows, would be an unconventional cash flow pattern. So that is the first principle, that is, decisions should be based on cash flows. Second, cash flows are based on opportunity costs. So let's say that you start a factory and the factory generates $100 every year. Now, this is what the expectation is for the near future. Now this factory was set up on your father's land, and your father is not charging any rent on the factory's land. So that's an expense that you don't have to make at the moment. But had you leased the land from an independent party, then the land cost itself, or the lease on the land, would have been about $150 a year. So tell me that when we are considering the cash flows for this project, should you consider $100 of cash inflows, or would you rather consider 100 minus 150, that is a $50 of cash outflow that the factory is resulting? So cash flows are based on opportunity costs. Please watch the review on time value of money. So opportunity cost is the benefit foregone by undertaking an investment. It can be also denoted as the return that the investment was making in its next best use. So in the next best use, we can assume that the land would have at least got us $150. Or because I've started this factory and I'm getting $100, I'm foregoing $150. That is a benefit forgone. So cash flows should be based on opportunity costs. If there is a cost like this, then that must be deducted from the cash flows. That is, for the purpose of analysis, we will use the cash flows of minus $50 every year, not the positive 100 that the project actually is making. We know that money has time value, so timing of cash flows is important. That is, if two projects are giving me the same absolute cash flows, I would prefer the project which gives the cash flows sooner rather than later. So if A and B are both giving $100, then it's the project where the cash flows are front-ended that would be preferred. Cash flows are analyzed on an after-tax basis. So please recall from the review on financial reporting, or if you're going to read it henceforth, please remember that tax is a cash expense. So it needs to be deducted from our cash flows to calculate the value of a project. Financing costs. So what is the meaning of financing, guys? If when we undertake a project, financing can come from two sources. Either we go to a bank and raise debt, or we rope in some equity investors. So broadly speaking, we raise money either through debt or equity. In the case of debt, I'm obligated to make interest payments. In the case of equity, I need to give a return on equity. I may sometimes be obligated to pay dividends, etc. So there are costs of raising financing or raising money. Interest and dividends are some representations of these costs. But remember, guys, that financing costs, cost of debt and cost of equity, are both accounted for in the project's required rate of return. So we will study in the next session the concept of weighted average cost of capital, which tells us that if the project is not returning sufficient money, if it's not returning above its cost of capital, then the project should not be undertaken. The costs of financing should not be deducted, or do not deduct interest or dividends from the cash flows. Very important to remember. The confusion more comes with interest expense because it is deducted from the net profit. Dividends anyways are after the net profit. So remember that interest expense, even though deducted from the net profit, should not be deducted from our cash flows when considering the value of a project in corporate finance. The cost of financing is covered in the, or is adequately represented in the required rate of return. Two projects will be called independent if they have no relation to one another, or they have nothing to do with one another. That is, if both projects are profitable or both projects meet our criteria, both can be independently accepted or rejected. Mutually exclusive projects, on the other hand, can be taken only one at a time. So if two projects are mutually exclusive, then both of them cannot be taken together. So let's say I have a piece of land. I can either start a fashion store or I can start a pharmacy. I can't do both because it's just one plot of land. A certain other related definitions that you should be aware of, that we are at times required to do project sequencing. That is, if one step is successful or if one project is successful, then many others or another can be taken up. But if the first step fails, then even the subsequent phases of the project will not be started upon. So the projects are often taken up in a sequence. And if the first is successful, then more can be undertaken. Unlimited funds implies that all potentially valuable projects should be accepted. That is, there is no limit on the amount of debt and equity I will be able to raise. There are enough banks sitting to fund me, and there are enough equity investors who will provide the equity for my projects. Capital rationing, on the other hand, works with limited funds. So there is a limit on the amount of debt and equity that we can raise, and we pick the best projects to maximize the value within these limited funds, or utilizing these limited funds. The first concept that we'll study as a part of analyzing our ideas or analyzing our proposals would be the concept of NPV. So NPV stands for net present value. We studied this in time value of money as well. It is defined as the present value of all cash inflows minus the present value of all cash outflows. So if the cash flows are conventional, then we will have one initial investment outlay, that is a large negative cash flow, or a series of a few large negative cash flows for the first couple of years, and subsequently the project will start throwing positive cash flows in years 1, 2, 3, 4, so on and so forth. So the first cash flow, the cash flow coming at the end of year 1, would be discounted back by 1 plus the required rate of return for the project. How this required rate is derived, we will study in the next review, that is on the cost of capital. But just remember that it is related to the cost of financing, that is the cost of equity and the cost of debt that I'm getting money at. Cash flow coming at the end of year 2 will be discounted back by 1 plus k to the power 2, so on and so forth. So let's do an example and understand it better. Using the project cash flows presented in the table below, compare the NPV of each project cash flows and determine for each project whether it should be accepted or rejected. Now remember guys, the decision criteria with NPV is that if NPV is greater than 0, then the project should be accepted, or there is more value coming in than what is going out. The present value of cash inflows is higher than the present value of cash outflows. If NPV on the other hand is negative, then the project should be rejected. Now for project A, there is an initial cash outlay of $3,000 that is made at t equal to 0. And from the first year onwards, we start getting in our positive cash flows, $1,800 in the first year, $1,200 in the second, so on and so forth. So the first cash flow, or the cash flow at t equal to 0, will remain the same, or it will be discounted back by 1 plus the cost of equity to the power 0. Second one is coming 1 year later. So in present value terms, it's not worth 1,800. Had it been 1,800 today, the value would have been equal to 1,800, but since it's coming 1 year later, we'll have to compute its present value to see the worth today, so on and so forth for all the other cash flows. So 3000 was the initial cash outlay. Year 1, year 2, year 3, and year 4. The discount rate K is given in the question as 10%. So we'll be able to calculate the NPV as shown, and the figure will come out to be 502.36. Please note that the detailed calculation has already been shown in the review on quantitative analysis, but for the sake of revision and practice, we'll do the calculation once again just to make sure that we understand it well. So please get your BA2 Plus calculators out, either the regular one or the professional. So we first need to enter our cash flows in the cash flow sheet. So press the button CF and you'll see CF0 equal to 0, or if you have some previously entered value from another question, that value would be flashing. Always remember, the first step we do after we enter the cash flow sheet is that we clear work. So press the button second and press clear out. That is what you're accessing is clear work written on top of the button. What this does is that it will clear all previously stored values in the cash flow sheet, and you can now start entering your cash flows. So our initial cash outlay was $3,000. So press the button 3000, press plus minus, that'll make it minus 3000, and then press enter. Please note, enter is different from the equal to sign. So when I say enter, it's the second button in the first row, and you'll see CF0 is minus 3000 flashing on your screen. Scroll down to CO1, and what are we getting at the end of the first year? It's $1,800. So press the button 1800 and press enter. Scroll down again and you'll see FO1 equals 1. Now this provision is given in case the number 1800 was repeating itself 10 times. That is 10 years the cash flows was a constant 1800. Then instead of entering 1800 10 times, we would have just entered the frequency as 10 and the calculator would have understood. In our case, however, the cash flow is coming only once, so we'll let it be and scroll down further to CO2. The cash flow at the end of year 2 is $1,200. So press 1200 and press enter. Scroll down again, let FO2 be equal to 1. At the end of year 3, we're getting $800. Scroll down, let FO3 be 1, and finally we get $400 at the end of year 4. If you scroll down and you keep scrolling down, you will come back to CF0 equal to minus 3000. So we've entered the cash flows in our cash flow sheet. We now need to compute the NPV of these cash flows. So press the button NPV, that is adjacent to the CF button, and enter the discount rate I as 10% in the question. So press the button 10, press enter. Scroll down again and you'll see NPV equal to 0 or some previous value that you may have calculated. As you see NPV, press the button compute and you'll see the NPV as 502.36. So just a revision on how to calculate the NPV. Please do it for the cash flows for project B and verify that they come out to be 292.39. Please note that NPV is a measure of the absolute addition in shareholder wealth because of a project. So we don't divide the cash flows by anything. We don't compute any percentages. We take the present value of the inflows and subtract the present value of the outflows. So it is in present value terms the absolute addition that is happening to our investors. So we see in this case that the NPV for both projects, project A as well as project B, are positive. That is, both projects are adding to shareholders' wealth. Hence, both of them should be accepted. So both project A and B have positive NPVs. So both should be accepted and executed by the company. A related concept is that of IRR. Now, IRR stands for internal rate of return. So just like NPV was the present value of cash inflows minus the present value of cash outflows, please tell me what would happen if this discount rate K went up. So as we increase K, would the initial cash outlay change, or would the negative cash flows change? So they would remain the same, but what would happen to the positive cash flows? As we divide them by a higher denominator, the value of all these fractions will go down. So the present value of the inflows will go down. The present value of the cash outflows would remain the same, assuming there is one big cash flow at the beginning of the project. So the NP would start going down. At some K, the NPV would become 0. That K is called the internal rate of return, or the IRR. So the IRR is the discount rate for which the NPV of a project is equal to 0. So if we compute the NPV using the discount rate as the IRR, then the NPV would come out to be 0. The internal rate of return does not give us a sense of the absolute shareholder wealth addition, but it does give us a sense of profitability and the margin of error, as we will study in the coming slides. So projects with higher IRRs can be thought of as more profitable projects, or projects that are giving us more return per dollar invested. So continuing with the cash flows presented in the previous table for projects A and B, compute the IRR for each project and determine whether to accept or reject each project, assuming that the projects are independent and that the required rate of return is 10%. Now please remember that the decision rule for the IRR analysis is that if the IRR is greater than the cost of capital, what will happen? If IRR is greater than cost of capital, that means for the NPV to be equal to 0, I need to discount by something greater than the cost of capital. That is, if I discount by the cost of capital, the NPV will be positive. So if IRR is greater than the cost of capital, the NPV of the project will be positive and the project should be accepted. If on the other hand the IRR is less than the cost of capital, then the NPV will be negative. Why? Because discounting at the IRR gives me an NPV of 0. If I actually discount by the cost of capital, which is the correct method of calculating the NPV, then the NPV will come out to be negative, because discounting at a lower rate gives me a number of 0. Discounting at a higher rate will give me a negative number, or the project should be rejected. We'll explain it again from the example. So let's recall the cash flow was minus 3,000 at t equal to 0, 1,800 dollars at the end of t equal to 1, $1,200 at the end of t equal to 2, as given. Now we need to compute the discount rate that would make the NPV, that is the present value of the cash inflows minus the present value of the outflows, equal to 0. So let's take help of the BA2 Plus calculator again. Now we've already inputted the cash flows in the cash flow sheet, so no need to do that exercise again. You can simply move on to the right and press the button IRR. So as you press IRR, you will see 0 or any previously computed value, and then simply press the button compute. As you compute, you will get the IRR for the project as 19.75%. So what should we do with project A? Should we accept it or should we reject it? The cost of capital, please recall, was equal to 10%. So if the project is generating an IRR of 19.5%, that means when I'm discounting by 19.5, the NPV is 0. Had I discounted by 10%, which is my actual cost of capital, what would have happened to the NPV? It would have been positive, as all these cash flows would have been higher because they're being discounted by a lesser number. So if IRR is greater than the cost of capital, that means the NPV would be positive, or the project should be accepted. Similarly, you can do the calculation in the same manner for project B and verify that both IRRs come out to be higher than the cost of capital of 10%, hence both projects should be accepted. So it was 19.75, not 19.5. So that's the concept of NPV and IRR. We'll now try to study the NPV profile of the project at different discount rates. So at 10% discount rate, please recall the NPV came out to be 502.36. Now let's see what happens as I change the discount rate a little bit. So let's go back to the NPV sheet. At 10% we've already calculated. Let's see how much the NPV would be if the discount rate was 15%. So press the button 15 and press enter. Scroll down and press compute. The NPV comes out to be 227.3 at 15%. So we can make note of that. That is if I change it to 5%, that is, I go back to the interest rate, scroll up, press 5 and press enter, scroll down and compute the NPV. It comes out to be 822.87. Similarly, I can do the calculation at different discount rates and plot the NPV profile for the projects. So at a discount rate of 5%, we just saw that the NPV comes out to be 822.87. At 10% it is 502.36. At 15% the NPV is approximately 227.3. So as the interest rate or the rate of discounting increases, the NPV keeps coming down. If we do a similar analysis for project B, we will notice that the NPV falls even more quickly than for project A. So at 0%, project B has an NPV of 1400. At 15%, project A still has a positive NPV, whereas the NPV of project B has gone down to a negative 114.73. Let's try to analyze why the behavior is as such. So if you notice the two projects, project B actually has higher absolute cash flows. So if we sum up the total cash inflows for project B, it is a number of $4,400, 2,000 plus 1,200 plus 800 plus 400. Whereas for project B, this number is 4,200. But on the flip side, project A has cash flows coming much sooner than for project B. Now as the discount rate moves up, as it goes from 10 to 15 or 5 to 10 to 15, please note that the major brunt of this high denominator will be borne by cash flows further out, because the cash flow coming at the end of t equal to 4 will get discounted back by 1 plus r to the power 4. So if this discount rate increases marginally, it will exponentially bring down the value of the fourth cash flow. It'll affect the first cash flow also, but not as much because it is raised only to the power of 1. So 2 and 4 may have only a 2 units difference. But remember, 2 square and 4 square will have a difference of 12 units. So that's what's coming into play. That as the discount rate increases, the value of this large chunky cash flows moves down exponentially and brings down the NPV of project B much faster than that of project A, which has cash flows which are more front-ended. So NPVs of both projects fall, A as well as B. But B sees a sharper fall with the increase in discount rate because cash flows are more back-ended and there's an exponential effect as the discount rate goes up. This brings us to a very important concept of crossover rate. So crossover rate is the rate or the discount rate at which the NPVs of the two projects are the same. So if I have a project A and a project B, then the crossover rate means that rate at which the NPV of project A will be the same as the NPV of project B. Now let's assume that that discount rate is equal to R, and let's try to solve this question. Now please carefully understand the explanation, as your curriculum notes don't explain this too well. But if I look at project A, is project A, or rather, can project A be simply thought of as project B and another negative cash flow of $350 at t equal to 0? Or in 2001? In 2002, project A can be thought of as the same as project B plus another $110 plus $150 in year 3, or rather 2003, and another $180 in 2004. So apart from these highlighted differences, the cash flows of project A are the same as project B. Now, whatever be the discount rate, this part of project A's cash flows, that is the part of project A's cash flows that are overlapping with project B, will have the same present value as that of project B, because whatever be the discount rate, project B's NAV would be the present value of these cash flows. So the question now remains that what is that discount rate that would make the NPV of these highlighted differences 0? So if the present value of these differences sums up to be a value of 0, then at that rate the NPV of both project A and project B would be the same. Because whatever the discount rate is, the discount rate R, at that discount rate these remaining or differential cash flows have no present value. The part of the cash flows that are overlapping between A and B will anyways have the same NPV, whatever be the discount rate, because they are exactly the same. So essentially, to compute the crossover rate, I just need to compute that discount rate at which the NPV of the difference of the cash flows is equal to 0. That is, you need to compute the IRR of this hypothetical project C, whose cash flows are nothing but the difference of the cash flows of project A and project B. So let's do it. So go back to your cash flow sheet again and first clear work. The initial cash flow will now be entered as 350 negative. Scroll down. The difference between the first year's cash flows is $110. So press the button 110 and press enter. Scroll down. The second year's cash flows differ by $150 and $180 for the third year. Press the button IRR and press compute. So you'll see the IRR coming as 11.37%. So R comes out to be 11.37%. And please verify that if you compute the NPV of project A at a discount rate of 11.37% and the NPV of project B at the rate of 11.37%, they will both come out to be exactly the same. That is called the crossover rate. And the rate at which the NPV of project A is the same as the NPV of project B. So we'll now move on to studying the advantages and disadvantages of the two methods. We'll start with the net present value first. As mentioned earlier, that NPV is a direct measure of absolute shareholder wealth addition, or the expected increase in firm value because of the project. It is the absolute present value of the cash inflows minus those of the outflows. So theoretically, as we will prove very soon, it is the best method for analyzing a project or computing the value to shareholders of a project. On the flip side, however, NPV does not include any consideration of the size of the project. So let's assume that the NPV of a project A comes out to be $1 million. Now, it's a positive NPV, hence the project should be accepted. NPV of another project B is $1 million, but the difference is that the present value of cash inflows for project A was $100 million minus the present value of the cash outflows of 99, giving an NPV of $1 million. For project B, the cash inflows were $2 million and the present value of the outflows was $1 million, again giving an NPV of $1 million. If you looked at the NPV of the two projects standalone, both should have been accepted and both look like positive value adding projects. However, we can see that the margin of error is much smaller in project A and much higher in project B. That is, if my cash flow estimation is off by 10-15%, then it is unlikely that the NPV of project B is going to become negative from a positive value, because the cash inflows are twice as much as the outflows. Whereas in project A, a slight miscalculation or a slight overestimation would make this NPV negative and the project unviable for the company. So the NPV as a standalone measure does not give us this indication of the margin of error. And that is why we need assistance of the IRR and other measures to help us. Moving on to the IRR, as discussed earlier, IRR measures the profitability as a percentage, or it shows the return on each dollar invested. It gives me a sense of the margin of error. So if the IRR comes out to be 15% and the cost of capital is 14.5%, then I know that yes, we are accepting the project because IRR is higher than the cost of capital, but it's higher only by 50 basis points or 0.5%. So I know that if my cash flow estimation goes wrong, then the project may have a negative NPV or it may not be viable. So it provides information on the margin of safety, which NPV does not, as discussed earlier. On the flip side, IRR is not theoretically the best method as NPV was. So in cases where there is a conflicting ranking, that is the NPV says project A, whereas the IRR for another project B is higher, and the projects are mutually exclusive, that is, it can be either A or B, not both, we will have to prefer the NPV method and not the IRR, as we will discuss with an example in the next slide. Secondly, the mathematical calculation for calculating the IRR is relatively complicated, because the IRR is a solution to a complex equation which often ranges to the power of 4 to the power of 5. So there can very easily be terms of 1 plus IRR to the power 10, some of which has to be equal to 0. So the cash flows, all cash flows need to be discounted. Hence this equation is not a simple linear equation or a simple quadratic equation. It can become a very complicated equation to solve, and oftentimes we'll see that either there is no solution. So even for highly profitable projects, it's just that there is no value that makes the NPV 0. Or for a cubic equation, quadratic equation, there are many IRRs, so we do not know which one to use. Now, conflicting rankings between NPV and IRR, that is, NPV is favoring one project while IRR is favoring the other, can happen in many instances. So herein we take an example wherein the initial investment for two projects is the same, but the cash flow profile henceforth varies and the decision becomes conflicting. The projects are mutually exclusive. So consider two projects with an initial investment of 1500 euros and a required rate of return of 10%. Project X will generate cash flows of 600 euro at the end of each of the next 5 years. Project Y will generate a single cash flow of 4,500 euros at the end of the 5th year. So we've depicted the cash flow profiles here. Both have an initial investment of 1500 euros. And then we can use our calculators with a discount rate of 10% and compute the NPV of both projects. So NPV of project X comes out to be 774.47, whereas that of project Y comes out to be 1294.15. With the same cash flow sheet, if I just press the button IRR and compute the IRR, however, for project X comes out to be higher at 28.64%, whereas that for project Y is lower at 24.57%. So in such a case, which project should I choose? Should I choose project X or project Y? Remember, the projects are mutually exclusive. That is, only one of them can be taken. If the projects were not mutually exclusive, then both could have been accepted, rather both should have been accepted, because both are positively impacting shareholder wealth. But because at one point in time only one of them can be taken, always go with the project with the higher NPV. And why logically should you do that? We will just prove in the coming slides. But remember, whenever in doubt, always choose the higher NPV. So in this case, we will choose project Y. Now let's understand, why do we do this? So why higher NPV? Let's assume I have a plot of land and I can either build a school on that plot of land or I can build my factory. Same plot. So for the school, I will need to make an investment of $100, and at the end of year 1, I can sell the school or I will get a cash inflow of $400. So I invested 100 and I got back 400 at the end of the year. So positive NPV and definitely very high IRR also. So if we input the cash flows in the cash flow sheet and compute the IRR, it will come out to be a very high number. Let's try to do it. So go to the cash flow sheet, clear work first, press 100 minus as the cash outflow, and at the end of the first year you're getting $400 as the cash inflow. if I compute the IRR, it comes out to be 300% for the school project. And at 10% discount rate, the NPV is also fairly positive. It comes out to be about $263.63. So the IRR is 300% and the NPV was also around $263. If I set up a factory, however, I will have to invest $100 million. So it will be a cash outflow of $100 million, and at the end of the first year I will only get about $150 million if I sell the factory. So at a 10% discount rate, if I compute the NPV and the IRR for the factory project, then the IRR will be slightly lower. So the initial investment is $100 million. Clear work first, enter $100 million again as the initial cash outflow. Scroll down and enter the cash inflow at the end of year 1 to be $150 million. Press the button IRR and press compute. So we see that the IRR is only about 50%, and if you compute the NPV for this cash flow at 10%, then the NPV comes out to be $36.63 million. So the IRR is about 50% for my factory project, and NPV is about $36 million. But please note, you can do either one of two things. Either make the school or make the factory. So what will you do, guys? The school is a very profitable project. But just because it is profitable doesn't mean it is giving you high absolute profits. All said and done, you may have earned 300%, but you've gained what? Only $263. Rather, had you invested more money, sure, the percentage return would have been lower, but in absolute terms, your shareholders would be richer by $36 million. So what would they want? $263 or $36 million, even if profitability is a little lower? So that's why we choose the higher NPV, because it means more absolute shareholder wealth, whereas the IRR only implies a high profitability. So if we delve deeper into the assumptions made by the NPV and the IRR, we'll see that the NPV implicitly assumes reinvestment at the discount rate. It's because all cash flows are discounted back by the cost of capital or the discount rate. And please recall from the review on time value of money that the appropriate rate to discount any cash flow is the opportunity cost, or the rate that capital could have earned had you received it today. Now, please understand that the discount rate, which in the case of NPV is the cost of capital, and we'll study this in more detail in the next review, is a conservative assumption. We call it conservative because even in the worst case, even if there were no reinvestment opportunities available, the firm still could have earned the cost of capital on its cash flows. So even if you had nowhere to reinvest, let's say even government bonds you couldn't invest in, no other project you could invest in, you could still earn the rate K. How? Just use the cash flow to repay your debt and equity. If you repay your debt, you save on the interest expense, and as you repay your equity, you don't have to pay them the cost of equity. So even if you have no investment opportunities, you can earn the cost of capital by simply repaying your capital supplies or your debt and equity. So the NPV assumption is a good assumption. It is a conservative assumption. Whereas, what does the IRR assume reinvestment at? It assumes reinvestment at the IRR because each cash flow is discounted back by the IRR. So the assumption is that whatever is the IRR, the reinvestment will also happen at that IRR, which may or may not be available. Your one project may be very profitable, but doesn't mean that you will have reinvestment opportunities at the same rate. That's another reason why we prefer the NPV approach over the IRR approach, because this is a more conservative assumption, a more conservative approximation that will always at least be true. We discussed earlier, because of the mathematical nature of the IRR calculation, for a cubic quadratic equation there could be multiple IRRs, or the equation at times may have no solution. This problem will never happen for NPV because the cash flows are known, the discount rate is known, there will always be an NPV. It could be positive or negative, but it can always be calculated. So let's try to see how the NPV affects the stock price. Please note that the example is only indicative in nature. Many other factors actually go into the determination of the stock price, but let's try to solve the question nonetheless. So General Electric is investing $600 million in new printing equipment. So this is the investment being made. Cash outflow. The present value of the cash inflows resulting from this equipment is $850 million. So what is the NPV of the project? The present value of cash inflows minus the present value of the cash outflows would be 850 minus 600, that is $250 million is the NPV of the new printing equipment. Now GE currently has 100 million shares outstanding with a CMP or current market price of $45 per share. Assuming that this project is new and is independent of other expectations about the company. So the market hasn't discounted this new information and this new value in any format up till now. So when this new project is disclosed to the public, calculate the effect of the new equipment on the value of the company and the effect on GE's stock price, assuming everything happens rationally. So the value of the company is derived, or the equity value of any company we'll study in equity valuation is simply the market price per share into the number of shares. So this is how much I need to pay to buy out all shares of the company or to buy out the entire company. That is $45 into 100 million, which is $4,500 million. of $4.5 billion is the value of the company right now. After the disclosure of this new project or the acquisition of this new project, this value will go up by $250 million to a total of $4750 million. And what will be the new stock price per share? It will be the total value upon the total number of shares. That is $47.5 per share. Or you can say that $45 was the current value. An additional value of $2.50 per share will again give you the total price of $47.5 per share. So guys, it's a simplistic example, but that's how this, or definitely a calculation like this plays a part in the determination of the stock price, along with other factors that we will study. We'll now move on to certain other analytical tools aside the NPV and IRR that are also used in analyzing capital decisions. And the first one that we'll study is called the payback period. So the payback period is defined as the number of years it takes to recover the initial cost of an investment. How long before I get my money back? Best understood with the help of an example. So calculate the payback periods for the two projects that have cash flows presented below. So I'll do it for project A. Please try it out and verify the answer for project B yourself. So we see that we make an initial investment of $3,000 in project A. At the end of year 1, we get back $2,000. So how much is remaining now? I've already received $2,000, so what is remaining is another $1,000 because I invested $3,000 and $2,000 has come back, so $1,000 is remaining. At the end of the second year, I get another $800. So if I've received another $800, then how much is remaining now? Only about $200. And at the end of year 3, I receive another $800. So including year 3, I have recovered my investment and I now have an excess of about $600. So in how much time have I recovered my initial cost? Somewhere between period 2 and 3. Or year 2 and 3. So let's assume that the cash flows are coming uniformly throughout the year. So we are getting $800 in the 1 year, that is the third year. So in how much time will I get $200 that I need? I need another $200 to recover my entire money because $2,800 I have already received. And another $200 and I'll be home with $3,000. So $800 is what I'm getting in the whole year. $200 I will get in approximately 1/4 of a year. That is 1 by 800 into 200. That means it takes me approximately 2 years and 3 months to get my money back, or 2.25 years is my payback. Similarly, please compute for project B and verify that the payback period for A is 2.25 years and for project B comes out to be 3.45 years. The discounted payback period is exactly the same calculation. There's only one difference, that we now use the discounted cash flows to calculate our payback period. So how long does it take for me to recover my investment, assuming the discounted value of the cash flows in each of the years? So if we take the same project A, then we're getting $3,000 as an initial cash outflow, $2,000 coming in at the end of year 1, another $800 coming in year 2, year 3, $500 in year 4. So what will be the discounted back value of this first cash flow? It's $2,000, but it's coming at the end of the year. So I'll have to discount it back by 1 year, and the cost of capital is given to be 10%. So this comes out to be $1,800. That is the discounted back value of the first cash flow. The discounted back value of the second cash flow will be calculated as 800 upon 1.1 to the power 2, which comes out to be a value of $661. And for the third year, the discounted back value of the cash flow will be 800 upon 1.1 to the power 3. Let's just do one of these calculations to verify that they're correct. So let's do it for the third year. So press the button 800. We can clear out first. Then press 800. Store it in the memory register 1. Press 1.1 to the power 3. Press the button y to the power x 3 and press equal to. Store it in the memory register 2. Recall 1 divided by recall 2 will give you $601 as we have mentioned. So now that you have the discounted cash flows, can you compute the payback period using these cash flows? So I need to recover $3,000. Please note that the discounted back value of this $3,000 will be the same as 3,000 because it is coming at t equal to 0, or it is a cash flow at t equal to 0. So $1,800 comes back in year 1. I'm still left with $1,200 to be recovered. Another $661 comes in year 2. That means I'm still left with $539 to recover. Another $601 comes in year 3. That means somewhere between year 2 and 3, I have recovered my $539. Let's apply the same calculation. Over the whole year, I get $601. How long will it take for me to recover $539? It'll be 1 upon 601 into 539. So 539 divided by 601. It's about 0.9 years. So I can say that in approximately 2.9 years is the discounted payback period for the project. Again, please do the calculation for project B and verify the answers. So for project A, it comes out to be 2.9 years, and for project B, it comes out to be 3.93 years, as you can calculate. Now the last concept for today, again pretty straightforward now that we understand NPV and IRR, is called the profitability index. So the profitability index is simply the present value of future cash flows upon the initial cash outflow. So assuming it is a conventional project, the NPV is nothing but the present value of the future cash flows, which are inflows, minus the initial cash outflow. So the present value of inflows can be written as the NPV plus the initial cash outflow. Or you can write that the profitability index, which is the present value of future cash flows, can be given as NPV plus the initial cash outflow divided by the initial cash outflow, which is nothing but 1 plus the NPV upon the initial cash outflow. Now, when do we select the project, or when do we accept a project? We accept when NPV is greater than 0. So if NPV is greater than 0, what will the profitability index be? It will be greater than 1. So if profitability index is greater than 1, it means the NPV is greater than 0, or you should accept the project. If NPV is negative, so if in this equation, if NPV was negative, the profitability index would have been a number less than 1. So if the profitability index is less than 1, then the NPV of the project is negative and you should reject the project. So guys, that was about the review on capital budgeting. You studied some very interesting concepts and you delved deep into understanding NPV, IRR and capital budgeting. Lots of very interesting questions on these topics in your question banks. So please make sure that you're practicing a lot. Practice is the key to success on the exam, and make sure you master this topic. It is an easy topic. It is a scoring subject. It'll help you at level 2 as well. So make sure you leave no loose ends on that regard. Thank you so much, and see you next time.